Three, two, one. Welcome to G Money, real talk on everything mortgages and real estate. Today I'm here with some APM, American Pacific Mortgage veterans here. Veteran. All right. Since we're so early on, I'm going to start that one over. Okay. All right. 3, 2, 1. Welcome to G Money, real talk on everything mortgages and real estate. Today I'm here with my friend Des and April. Welcome both.
Thank you.
Thank you.
And please share who are you and why are you here?
Well, I'm Lenz, Director of American Pacific Reverse Mortgage, and we're here to do a training session for your favorite realtors and kind of give them an idea how reverse mortgage works. We're excited to do that. And we've got with us
April Nelson, Manager of Branch Support and Training.
I have the best in the business here, specializing in reverse mortgages. This is going on my 22nd year with American Pacific Mortgage, and one of the beautiful things about them is that they've created different, I'll say, essential divisions that really are here to support us in different unique mortgage programs. The reverse mortgage group was started by Des in 2005, is that correct?
we actually started doing them in 2000. We set up the division in 2005, right?
Yeah.
Yeah.
You know, so reverse mortgages are something that's a little bit more technical, definitely a lot of questions that go into it. And so to have an elite team that this is all they do, they specialize in it. We've got Des that's been doing this for a very long time. And then supporting Des in the outreach is April. And so as they mentioned today, this afternoon, we're going to do an in-person lunch and learn for a lot of our local realtors. But for our listeners out there, we're going to give you a lot of the same information so you can become experts on reverse mortgages. So let's kick it off with the fun one. How do we all start out in real estate, right? Mortgages. You know, it's not always the lifelong dream of, being a police officer or a nurse or a doctor. So April, how did you get started?
Yeah, so I actually started young. I was started in high school. Went to, high school for half a day and then went to work in the mortgage business for the other half. So I started out as a receptionist in 1998.
Wow.
And it's the only job I ever had.
Oh, wow.
And just kind of worked my way up, processor, went into underwriting, went into closing and then originating.
Yeah.
So I've been originating reverse mortgages now since 2004. And I've been with American Pacific Mortgage for 15 years, since 2009.
And what was it about the reverse mortgages that interest you?
Just, the fulfilling, moments that you have. When you close a loan, you're helping somebody. You're just, genuinely the feelings that you get, to help a senior and help them achieve their goals and, closing that loan and, it's just a great business to be in.
And I can definitely share that. I originate, forward mortgages, reverse mortgages. And so, there's always that unique, first time home buyer, right? It's the first time they've purchased a home. But then you have the other side of that where there is a senior, somebody that's been in their home many years. And, my grandmother comes to mind. She's 93. She's never leaving her home.
Right.
And so that's her safe haven. That's her shelter. It's beyond shelter. It's her memories. It's her everything, to be honest. My grandpa passed away 20 some years ago. And so, everything is a memory of him and in honor of him. And, it's very special to her. And so, the reverse mortgages that I've closed, I can also, definitely recollect and sympathize very similar of like, you're not getting them their first home, but it's definitely probably their last home.
Right.
And for them to be comfortable and safe in the home that they've known for so long, there's a uniqueness to it and definitely a special feeling. So yeah, that's a great one. And Mr. Des, why don't you share? How did you get into mortgages?
That's a pretty good question. It was 1992.
Okay.
I emphasize 1992, not 1892. It's like
No. I can see the neon colors and the cut off T-shirt. You're painting it perfect. Keep going.
But I was in sales, and then a friend of mine said, you know what, why don't you come out? And I was working in Phoenix. He said, why don't you come out to Sacramento and check out the mortgage business? And I came out, and I loved it because it's numbers and people.
Yes.
You usually get one or the other, you know.
Right.
And so I got into business, and then in 2000, I went to American Pacific Mortgage
Okay.
and met with Kurt Reisick, the owner, and said, I want to do reverses.
Yeah.
He says, we don't do them. I go, well, what does it take? And he said, you got to go, you get the training, you figure out how to build it, you can do it. So we did. And so we started in 2000. And so I've been with American Pacific 24 years. And as April points out, the fulfilling part is we've built this reverse mortgage division together with a great group of people, and that's all they do. And you need it that way because it is a unique loan. There's no automation, really. It's, you know, dealing with a different clientele, usually a little slower process and
Yes.
stuff. But the fulfilling part is you help somebody stay in their last home
Right.
without financial stress, or it can be a strategic type of tool to help them maintain their retirement funds so they have a stream of income the rest of their life. So it really is a fun product to be able to deliver to people.
Yeah, absolutely. Well, let's dive into the basics. A reverse mortgage, we call it a reverse mortgage, but it's technically a HECM. Why home equity conversion mortgage? Who came up with that? What does that even mean?
Well, that's FHA speak. That's
Okay.
a government agency.
Okay.
It's got to have a weird name, right?
Yeah,
So-
right. And the acronym to follow.
Right.
I mean, yeah. Okay, so HECMs, but we call them reverse mortgages. And just give us the basics, Des.
Well, there's two, broad categories. There's the FHA product, which is the HECM. And
Okay.
then there's what we call a proprietary product, which is not FHA insured, but it's private investor money. And it's different programs. It aims at a different scenario, like larger values, which you have in this area.
Right.
So, you have two different tools, which each one of them has a different set of options that you can plug into to fit to the client situation. So overall, it's a loan, and it doesn't have to be repaid until the last borrower leaves the house, right?
Yeah.
And the nice thing about that is like there's no required monthly payment, little asterisk. They got to pay the taxes, the insurance, maintain the home, and it has to be their primary residence. So if you do those things and you live in that home, it gives you a lot of autonomy because it helps you financially stay in that home.
Right. Now, I hear it on the front lines. There's a lot of stigmas with reverse mortgages, and I again, I originate them. I know how they work. I don't believe, honestly, they're for everybody, but the people, they're for a select a select group that understand the value and see it more as a cash flow basis. And, there's many different reasons for that. So, quite frankly, it's a love or hate. And I don't know how much you see that, but I see like some people don't even, you bring it up and they don't even want to talk about it. Hey, move it along. But there's other people that this adds great value. And so, kind of diving into the guidelines a little bit more, or, reverse that. We'll just say the stigmas on that and the guidelines. FHA, hasn't they cleaned that up? I mean, isn't that something where they've really gone to improve some of the guidelines and protections for the consumer?
They have. And the thing about FHA is that they do make changes. And part of the changes are to protect the mortgage insurance fund so that it's, solvent. But mainly they aim at making decisions that assist the consumer and protect the consumer. And, there's bad actors in any,
Yes.
You name the profession.
Sure.
And so there have been some. And that's where a lot of the issues come from. And then well before FHA got into it, back in the late 80s, then you had, individual banks or, savings and loans building a program. And it wasn't really built to favor the consumer as much as that FHA loan. So
Sure.
what we noticed is with changes to the program and then experience, because this is just a financial tool.
Right.
And so how do you use this tool? And over time, that's the benefit of having done it 24 years.
Sure.
is you go, you know what? This person has X problem, and this, call it loan, with these set of features is going to help them solve that problem. And you get to recognizing the situation and what part of that tool, what benefits can be applied to that client to help them out. So, it's one of those that, there's some stigma and people go, don't want to talk about it.
Mm-hmm.
And where I start is like, look at my hair color, right?
I can relate.
Right. And I said, guess what? I have one. If I didn't have my own reverse mortgage and I knew how good they are, you'd say I'm stupid, right?
Yeah.
Because I understand what they can do.
Right.
For mine, it's a strategic use. For other people, it's a needs-based. It's the reason they can stay in their home. And others, it's the reason their retirement funds have a lot better chance of not running out during their retirement years.
Yeah.
And so there's strategies and stuff. And this all came from really experience, people learning how to use it, financial planners, realtors. So that's been the benefit over the years, but the stigma it's still around,
Well, and probably to clarify on my end, that's often very closed-minded people. If they're not even willing to listen to you about how the program works, they're shutting it down before they even hear it. It's what they think they know.
Right.
And so, hey, let's not dwell on that. Let's dwell on the people that are willing to listen and listen that, hey, this is a great opportunity and it has a lot of great features. So, April, diving into the kind of guidelines, what is minimum age and just some of the basics of, how you qualify for a reverse mortgage? And in my mind, in the beginning, I always thought I was, my grandma, 93 years old and in her home by herself. But what's the reality here?
Yeah, so you have to be 62 or older. We do have a proprietary product that goes down to age 55.
Oh, wow.
So generally,
Look, I just learned something. I didn't even know
Yeah,
that. All right. Keep going.
So, the FHA HECM product
Yeah.
is 62 and older. You have to occupy the property. It can't be done on, a rental property or a second home or
Right.
anything like that. You have to, maintain the property, pay the property taxes and insurance, and, cut the grass and maintain the roof, that
Sure.
kind of thing,
Yeah.
As Des always says, it doesn't have to be the Taj Mahal.
Yeah. Right.
So, and then, we have that proprietary product. We also have a ton of other products available. We have a reverse mortgage second.
Oh,
Yeah.
okay.
Yeah, that goes behind a lower interest rate first. We have a equity avail product, which it's another proprietary product, but it's a traditional loan for the first 10 years with a lower monthly payment and then rolls into a reverse mortgage after the 10 years.
Interesting.
So it's kind of a hybrid product.
Yeah, very much so.
Yeah.
And so a lot of, and many questions is it's always how much. And so you're suggesting the minimum age for most products, the HECM specifically, is 62. You're basing that on the youngest borrower. So if there's two borrowers, 67, 62, then the qualifying numbers are based upon the 62-year-old. Right?
Yeah.
And then also it's, and I never see, at one point I've seen the chart, but it's kind of like loan to value is correlated with age.
It's age, interest rate, property value, and, based on the weekly rate. So, yeah, the older you are, the more it lends.
Right. And then there's no maximum age. You could be 90 years old and apply for this. Mm-hmm. And obviously your life expectancy is lower, so they're willing to lend you more because the shortness or timeliness of, when you pass.
Right.
So, okay.
Right. Yeah. I mean, our oldest borrower was 107.
Oh my goodness.
Yeah.
Wow, that's pretty awesome.
Yeah. So basically, it continues on as long as they live in the property.
Right.
So
Yeah.
yeah.
And then let's talk more about the features here. Okay, as long as they live in the property, then what happens? There's so many, the bank's going to take my home. Does the bank take your home?
The bank does not take their home. The property is always titled to the borrower or in their trust. So they can, keep the home in their trust.
Yep.
And then, when they permanently vacate the property, that's when the loan is due and payable. So once, they vacate the home, whether they move or have to go into a facility or pass on, then the heirs would, take over the property.
And they have a time period. Is that correct?
So via will or trust, the heirs would have an initial 6-month period, and there's some little stipulations in there, but they can call you for that.
Yeah.
So they have an initial 6-month period to pay off the reverse mortgage. So they can either sell the property or refinance out of the reverse mortgage and pay off the reverse mortgage. So, if there's any upside down, or if they outlived the equity in the home while they were living in the home, the mortgage insurance would cover that difference. So the heirs are not liable.
Right. I get that often. Also, let's say they want to sell it, they can choose their realtor of choice. And
Yes.
Yeah. Okay.
Yep.
Perfect. Des, let's talk about some of the options of how it works and income stream. Again, just the traditional I keep coming back to that I'm thinking of is most people just think of it as, you receive $1,000 a month. That is one option, but there's actually several. You want to talk about the different options?
Right. So there's 3 major options and then a combination of the 3. But number one, you can have a lump sum. And you see that a lot. You have an existing mortgage and we want to pay it off, get rid of the payment. That's a lump sum payout to do that.
Right.
And then remaining funds they can receive as a monthly distribution, or they can have it as a line of credit that they can draw on in the future. And the line of credit has what we call a growth feature. So it's the interest rate plus 0.5%, which today equates to about an 8% growth factor. So they're not paying you interest on that line of credit, but they're saying you have available funds, more available funds based on the fact that you haven't touched that money, the money you haven't touched, and applying the factor, the interest rate plus 0.5%. So it gets pretty dramatic. So, a lot of people will set up this loan, say, as a line of credit. And let's say the line of credit's $200,000 at a growth rate of 8%. In 9 years, it's going to be $400,000.
Oh, wow.
And so in another 9 years, it's $800,000. It's compounding on itself.
Yeah.
So it's a really, really magic, strategic use of the money because you never know when you've saved enough money
Right.
to retire. So you go, oh, here's these tax-free funds because this is loan proceeds, not earned income. So it's not taxed.
Yeah.
So it gives you choices. So you're right. There's 3 ways to get it: line of credit, lump sum, and monthly payout. But you get to make choices and then tailor that program to the situation of the client.
Absolutely. And then can you combine them? Can you get some of a lump sum to pay off a small mortgage and
Right.
take a line of credit or a draw? Or
Absolutely.
Yeah.
Yeah, and that would be where the strategy comes into play. A lot of people think you have to own the home outright to use this product, and you
Right.
go, no. This number one thing we do with the loan is pay off existing mortgages and free up cash flow.
Right.
You don't have to send a check to the bank. It's like getting an income because you don't have the outgo anymore.
Right.
And then how you set up the rest of it, you look at the client situation, set it up. But here's the thing that's like magic. So let's say you did the loan and then you paid off an existing mortgage, and I'm going to say you had a line of credit. And after a while you go, man, I messed up. I wish I'd done a monthly payout. So you take the statement you get every month and you call the servicing lender and you say, I wish I'd set up a line of credit or a monthly payout. And they go, well, how much? And let's say it's $500. They put it into the computer and they go, first of next month, you're going to start getting your payout. Now they charge your account $20 one time and you start getting a monthly payout.
Wow.
So it's pretty cool. But then, you go to the casino and you win big, and then you say, well, I don't need the monthly payout. You call them back up, say, turn it off, and they'll reconvert that into the line of credit, and another $20 charge one time. But you can toggle it on or off, and most people don't realize that. It's a really, really amazing tool, even after you close the loan.
This is why you're here. You're here to give us all these ins and outs that, again, I originate these, but some of these little features and perks, it's like you got to sit down with the best to get all the insight. So thank you again for sharing. Now, you said 3, but technically there is, we'll call it a 4th method, and that's what I call it anyways, is the reverse mortgage purchase, right? And isn't that a different idea where the idea is to just break even, right? Put down just enough money to have no forward payment, no reverse payment. Elaborate. Tell us about that.
So let's say the client sold their home and they've got, we'll say $800,000, and they're going to buy another home, and they use a reverse mortgage for purchase. And let's say they're buying a $1 million home, and in this case, the loan amount is calculated in the computer, and it says the loan amount's $400,000. Well, that means they need $600,000 down out of the $800,000 they had. So they put down the minimum, like you say, break even. They have no required monthly payment, but they also have $200,000 they have not put into the home that can be added to their retirement reserves.
Right.
So it's a strategy so that you don't have to use up all your money, because it's dead money when it's in the house. You can't touch it.
Yeah.
And so on a traditional loan, great, you own the home, you don't have a payment, but you can't touch the money. Here you're saying, well, I have no monthly payment, plus I have money left over. So it's a really cool strategy. And there's one, I'm going to muddy the water for you.
Please.
So we call it overfunding. So they come in and they put the entire $800,000 into the house with the reverse mortgage.
Okay.
So that means the reverse mortgage balance is $200,000 on that $1 million purchase. But it also means that they have a $200,000 line of credit that gets established because they put more than the minimum required funds in. I've had a couple clients do this. It's really ingenious, because that $200,000 line of credit now is subject to the growth rate.
Yeah.
9 years later, it's $400,000. So, and in their case, they said, if we have the $200,000, we'll just go spend it on stuff.
Yeah.
Let's put it in the house. Let's have the line of credit, and this is our safety net. You're going, a brilliant little strategy.
Oh my gosh, I'm mind blown over here. I haven't even heard that one, and I'm excited for our lunch and learn today, just to get a room full of people and just go, this is a whole new world that you didn't even know was there, and it's really one more tool in our belt to help our clients, achieve success. And every little bit counts, especially with the inflation. I know we hear about that all the time, but it is reality. Everything's costing more and more. And
Right.
so, to do that step up home, you sell your home, you get a nice, chunk of proceeds that you can, prepay and forward pay, and have that line of credit in less than 10 years double itself. I mean, that is kind of putting it away for the future, but then you still have access to it. So it's really allowing your asset. Your home is an asset beyond shelter and protection and your home comforts, but it's an asset that you're really putting to use when you need it, and that's ingenious.
You know what? Interesting thing too, because let's say you did that overfunding, and then a year later you go, that was so stupid. Why'd I put that money in? Take it out.
Take it out, right?
You can't mess it up.
And so many of us are creatures of habit. It's like, you got money in the bank, you're going to spend it.
Yep.
So diversifying where you place your liquid cash, I think is a great way to go, especially knowing that you do have access to it.
Yep.
And it's not in the checking account that you just go to the ATM or you just go shopping with it. You have to think through that decision, but you still have access to it. So
Right.
that's beautiful. Yeah. So, I've seen my business grow more and more with the reverse mortgage, and I'm not saying I'm like the largest of the company here, but I've just seen personally, I do sporadically here and there, but more and more I'm seeing that I'm doing more business. Now, part of that is the gray hair that I have, and maybe it's the clientele that I'm attracted to, but are you finding that they're becoming more popular in general? Is it our aging, client base? I mean, do you find that more and more people are originating or open to the reverse mortgages?
I would say yes. Interest rates drive the loan amount. So the higher the rates, the lower the loan amount. Now, what we see is a lot of interest, but we're in a high interest rate environment. So you say, well, sometimes we can't pay off their existing loan because the loan that we calculate is not big enough. That's the downside. The upside is, hang on, we all think rates are going to come down, and when we do, bingo, then we just implement it and do it. But people are looking at it, and it is the aging,
Yeah.
and it's things like inflation. You look at price of cars, price of everything, and just being able to have cash flow. They've done surveys, and people with my hair color, and they say, hey, what are you afraid of? Public speaking, dying, or running out of money? Number one thing, running out of money.
Yeah.
Okay. And then the financial planners, they'll tell you there's three stages of retirement: go-go years, slow-go years, no-go years. So you go into retirement, you're in your 60s to 75, you're in the go-go years. But how are you going to fund the things you want to go do? And that's the beauty of this product. It creates a source of funds. You got to make good decisions. You don't want to squander it. But at the same time, you're going, why not make some improvements to the house? Why not go places? Why not have a beautiful motorcycle?
Yes.
I'm talking to you.
I'm listening. But just one? Do I only have to have one?
But, it is a beautiful thing that people are looking at the options. That's the good thing. And no is a complete sentence. If it doesn't work for somebody now, it can very well work from later. And you have past clients that their hair is turning gray.
Yeah.
And they're going to need a little help. And they'll be reaching out to you, or vice versa. It's going to be a good thing for both of you to find ways for them to get into retirement, stay in retirement, stay in their home, and enjoy retirement. So it's going to be good.
Absolutely.
And I also think it's, like you, getting out, educating people. The more education we can get out and let them know it's not a bad thing, because they all have this negative perception of the product, but it's not negative, and it's just getting out and educating people on the product and letting them know how it really works. So I think that's definitely helping.
That's a really good point, because all this is a financial tool. So is a 30-year fixed rate traditional loan. It's a tool. And so somebody says, oh, that tool is bad. It's like if you're walking in and you got a screwdriver in your hand. Screwdrivers are bad. No, they're appropriate to certain uses.
Sure.
And what we've discovered is this is a multi-tool. It can be used for a lot different and a lot more things than we ever thought. And that's what experience and changes to the program have really shown us.
Yeah.
Which is really cool.
Absolutely. Well, I've got to commend the reverse mortgage group, because, again, as I have a client that's interested, I gather some information. Are they of minimum age? What's their date of birth and estimated value? And they help put together options. And that I feel like I could do that on my own, but to have your support and to come back with, several options. It's not one. It's typically at least 4, if not 5 options that we can present and go over the clients. Now, I want to talk a little bit more. I want to have you talk, rather, kind of explain. And April, you definitely be a great one to kind of share on, what are the options typically that you're thinking through and providing. Now, normally it's what's the client's goal. So, before we go down Pandora's box of, yes, you can have a line of credit on one and a draw on another. Normally we've established, hey, they want to do a line of credit. Okay. Right. And then with that, you have what I see as different options. Maybe it's the FHA HECM, one's fixed, one's variable. Maybe walk us through those differences of what, you're typically presenting to us.
Right. So yeah, you hit the nail on the head with the goal. We always want to know the goal so we can provide the best product right up front and give you the tools to present that to your client. So, if you let us know the borrower needs to eliminate their payment or have that monthly income, we put together, let's say they need $1,000 monthly income, or, I had a client just yesterday who needs $5,000 for in-home care.
Oh, wow.
So we're going to set the quote up with the best product that we feel would meet that borrower's goal. So, they have a $5,000 monthly payment so they can make that in-home care, and then maybe the rest in a line of credit in case they have maybe a future emergency or something down the road. And then, we are going to give all the options available so you can present that to the client, because maybe we know part of the situation, but we don't know the full situation. And maybe they gave you a little bit of the situation on that initial call, but then when you have that client meeting, you find out a little more. So you have all of the options available and all the tools you need to be successful with that initial conversation.
Right. And, a lot of, maybe you can share, HECM, which is the FHA version, is my understanding. How much of the market is that? Because what I'm seeing is a lot more maybe of the proprietary. Yeah, if I can even speak it over here, I can't even say it. So yeah, elaborate. Some of the details on that, and how rigid is FHA, and that's what I'm curious on this. Personally, of how much do you do of just FHA? Where's their niche? Where do they fulfill the best need? On forward mortgages, hey. The $1 million question is always conventional or FHA,
right?
And I can talk your ear off on that. So,
right. So, we do mostly FHA products.
Okay.
The FHA, the closing costs are going to be a little bit higher on FHA, which is typical because we have the mortgage insurance.
Correct.
So, proprietary, it's going to be more of like a jumbo type product. So it lends a higher value limit than the FHA does. We're capped on FHA at about $1.1 million on value. So even if the property appraises for $2 million, the value cap is still that $1.1 million on FHA. So proprietary will lend on the full value of the home. So if you have a property, again, that's valued at $2 million, we might look at a proprietary product versus FHA.
And that could be a huge difference. I mean, if you're cutting the value in half, those numbers of, the line of credit size or the monthly income, that could be quite a difference.
Right. The proprietary also, they follow FHA guidelines to a certain degree, but when you have, let's say, a condo and FHA won't insure that condo, then we're going to look at proprietary because their guidelines are maybe a little bit more lenient than FHA would be. So we look at that full situation, we look at property type, that kind of thing, and just see what fits that box better.
Right.
So,
and then I also see many times the variable versus fixed. I think as our own comfort, we always want to hear that it's fixed. But, I think the more that you learn about adjustable and what it adjusts on and how it adjusts, then it's not as scary out there.
Right.
So with that, the reverse, is it still the 10-year treasury? Is that one of the main components of the adjustability?
The driver for us is the 10-year constant maturity treasury.
Okay.
And so the higher that index is, the rate's higher, the loan amount's lower, and vice versa.
Yeah.
But the thing about adjustables, I remember when I started doing these, that's all there were, just adjustables. I'm going, ooh, adjustable bad. Well, why is it bad? Well, it's bad because in traditional loans, if the rate goes up and the payment goes up and you can't make the payment, guess what? You lost your house.
Right.
But there's no payment.
Yes.
Right? So FHA is saying...
even more so, there's no payment. How are you going to lose your house?
So FHA is saying, look, if you want a line of credit, if you want a monthly payout, it has to be the adjustable. And there's a logic to that. If it was fixed rate at 4%, for instance, well, we're in a 7% environment, you're going, that's a problem because you're getting money, you're having, get money to hand out that you're going to get 4% return on, but you got to pay 7% to get it. So they go, no, it has to be an adjustable. So it's safe for the investor. So the fixed rate one says you get one-time distribution. You do not get line of credit. You don't get a monthly payout. And there's other, restrictions on it.
Right.
But the idea is that if it fits, if you're going to use, for instance, all the money at closing, you might look at the fixed rate loan. But right now, fixed rate loans, the rates are higher than the adjustable, so the loan amount is going to be less than the adjustable. So we look at those things, we weigh them and say, what is it they're trying to accomplish and what's going to work? Yeah. And so that's how you go down the checklist on that.
Yeah, and I often see that. It's always presented because it needs to be, and I think just as a comparison of, hey, you want to see fixed, here it is. Because it's fixed, The lender has to bear the brunt of the market, so it's going to be a little higher margin that's built into there, and then all your numbers are going to be less, right?
Right.
And so it definitely makes sense. You know, with the guidelines and just qualifying, I know we kind of skirted over that, but it's pretty simple. You just have to maintain it, right? So keep the grass mowed and cut, pay the utilities, pay the property taxes. Many of these clients are on fixed income. So, you know, walk us through your debt to income or how you're qualifying them.
Yeah, so, you know, we don't have to qualify with a house payment like on a
Yes.
traditional loan.
Yes.
So what we're really looking for is property taxes, insurance, any HOAs, things like that, and then their credit debt. So, you know, if they have a car payment or credit cards, things like that. And then we're based on a residual income, which most people won't really know what that is, but
Right.
it's a household number. So it's based on household size. So if there's a one-person household, they have to have $589 left over after all of their debt's been deducted from their income. That's
Sure.
the easiest way to say it.
Yes.
And then more of a household, you know, more members of a household, more income you have to qualify. But the good thing is, you know, a lot of people, if we have people come in on a traditional loan that don't qualify because they have to qualify with that house payment and they're on that fixed income.
Right.
But they will qualify on a reverse because we don't have to qualify with that house payment.
And you don't take utilities. It's just like a normal mortgage where it's just the insurance, homeowner's insurance, property taxes, anything else, and their minimum liabilities.
And then 14 cents a square foot.
That's
It's
correct.
like,
Oh, VA.
just like VA.
Here we go. Yeah.
Residual, just like VA. Yeah.
Yeah. So yeah, VA loans, they do the same thing where for maintenance costs, they take the square footage of the home and they apply 14 cents. And so it just kind of gives a rough number of if you were to pay the, you know, landscaper, pay the pest control, you know, what would it take to maintain that ongoing? And then is it similar with VA where the residual limit not only is by number of members in the household, but also region? In West Coast has a higher limit than
Yes.
Midwest?
Yes.
Okay.
Yep.
Man, they got together with VA and powwowed on that.
They did. I mean, it's the hybrid child that really works, you know.
Yeah. So one of the things I'm amazed by in our industry is the paperwork, and in reverse mortgages, there is no shortage of paperwork. What's the minimum quote that you guys send to me? Is it on page 16 is your estimate?
Is your comparison.
Yeah, but I mean, and then again, it's catering to the clientele. Number one is most of it is in person that you're sharing this. Most of it is tangible paper that you're going over the options so they can visibly see it, circle it, make notes, and do whatnot. Even the applications. Well, let's talk about that. We can't even take an application
Right.
until when, April?
Yeah, so I'll just kind of briefly go over that upfront process.
Yeah, please.
So, you know, we initially give them the quote package, which is paper,
Yes.
but it does give all of that upfront paper, you know, initial information to prepare them to, you know,
Local
make that
counseling
decision.
groups and
Right.
who they can consult for
Right.
counseling.
So it does have the counseling list, which the borrower does have to take mandatory counseling to move forward with the loan. So our process is, you know, give them that quote package, go over it with them, make sure it's the right decision for them to move forward. Once they decide to move forward, then we credit and income qualify them because we don't want them to go to counseling because there is a fee associated with
Right.
counseling. It's about $199. We don't want them to incur the fee or the time to do the counseling until they've been qualified, right?
Yeah.
And then once they've been qualified, they then schedule their appointment for counseling. So that list is included in that quote package. They take their counseling, call the counselor off of this list, schedule the counseling. Counseling takes, you know, a couple days to get. It's about an hour over the phone. All borrowers on title have to complete counseling in order to move forward with the loan. And then once counseling's completed, in California, there's a 7-day cooling off period before we can take an application and move forward with the loan.
So it's just a process just to get to the application, but it's
It
in
is.
good faith. And that's what I like is it's allowing them to, one, go over their options with you, the professional, two, go to an unbiased, intermediary that understands the products and programs. They can ask any questions and not be sold on something. And then they can really think through their decision. And a week later, hey, I'm going to apply. And they do.
Yep.
It seems, and maybe you can validate this, that the counseling list, there's also codes. Do they get a copy of the estimate with our programs?
Yes.
Correct? That's what I thought, but I don't want to make any assumptions here.
Right.
So that way the counselors are going over the exact same options that we've gone over with the clients.
Correct.
Beautiful. Yeah, I love that.
Yeah, to the paperwork question, you can virtually hear the trees falling as you're printing out one of these packages. But it's FHA and state government saying, we want the client protected.
Of course.
And then the counseling, we call an educational checkpoint. We've educated, but they get to ask, like you say, a neutral third party, any question that they were too shy to ask us. You go, okay, that's perfect. But when you go through that package, those are all disclosures for the client to say, this is what the loan does, this is how it works. And as the professional sitting with the client, you're going to explain that to them, and then they page by page sign off. It's a lot of paper. Like I said, I've done it myself, It's a lot of paper, but at the same time, it's just making sure that everybody in the transaction understands how it works, what the obligations are. And it looks complex, in a way it is, but we can make the complex understandable. We can't make it simple. That's impossible because there's just a lot of pages.
Yeah.
But we can make it understandable, and it's a great, great alternative for so many people.
Right.
And recently, we've gotten DocuSign capabilities. So
Yeah, my last client, we did do the DocuSign, and that went great.
yeah, so if they have, technology and they understand email and everything like that, some don't have it, but the ones that do, it makes it a lot easier to be able to go through that.
The other day, this week, I listened to a conference call with First American Title, and they've been introducing RON, which is Remote Online Notarization.
Oh.
And most of California has approved e-recordings, but it's still kind of caught up in everything to have an approved notary and the Secretary of State. And I won't bore you with all that, but it's just, I feel like going from a reverse mortgage where it's still heavy paper and that to, kind of the next era where it's going to be remote. And, quite frankly, I've even spoken about it on the podcast before that I don't love the idea, to be honest. I mean, I think there's a time and place, and there's some people that are going to love it. Hey, they can be in the Bahamas and signing their loan. For me, that I'm very hands-on and very much a people person, the loan signing is an opportunity for me to be there to represent my work, right? We've worked minimum 30 days most times, sometimes 6 months, depending upon how long, they've been searching for a home or looking for a loan. And so having such thick paperwork and, truth in lending and good faith estimate in your industry, different, these forms are not always the most user friendly,
Right.
And so to be there to go over that with the consumer, to me, is still very important. And so I don't know, I'm one side of me is okay with it, and it's just the way things go, right? Things evolve and technology will catch up at some point, but at the other side of me, it's still a people interaction that we want to make sure that we're doing a good job and servicing them and answering every question they have. I always say that, and in my forward mortgages, it's like, you're the one making the payment, not me. But every month that you're making that payment, you're going to think of me if something's good or bad, right? And so I guess with the reverse, where they don't make a payment, they won't think of me as often. But maybe,
They'll get the statement.
maybe
They'll still think of you because they're not making a payment.
yes,
That's even better.
when they're out to lunch or dinner or having that martini and saying, "Oh man, Greg recommended a great product."
Greg's buying us dinner. This is great.
Oh my goodness. Well, in the industry, Des, you might be a good one here. Is there any big changes coming, little changes, anything different or new on the horizon, or just the way that we do business? Speaking of the RON, the remote online notarization?
We don't see the automation on our side like that, like AI and RON
Yeah.
and things like that. And someday they'll catch up to it, but I'll be
Yeah.
retired. You know, it's like, and that's okay.
DocuSign is good enough.
Right. We thought that was a huge thing. But where we're going to see, I think, competition over the next years is in that proprietary product. Now, FHA will fine tune their product. We have a national organization that's in touch with FHA officials and stuff, and they'll be in contact with them about things that might improve the program, make it more consumer friendly, make it easier in some ways. But the proprietary stuff, I think you're going to see more competition there, and it could be just different products. There's been products that came and went. April mentioned the second mortgage. So it's a mortgage behind your current 30-year fix that has a super low payment. Well, the second was around a few years ago, and it disappeared. Nobody's using it. But right now, that is the loan for the times.
Wow.
Because if you think about it, they're fine making a $1,500 a month payment. That's not an issue. But they need money, and they don't want to go get a HELOC with a payment. They don't want to touch that first rate, existing first. So they go, let's get this second. And it goes all the way down to age 55. So there's so many things right now, and there will be other products that come up, things that, April and I can talk about it, but we won't come up with it. Somebody else will go, hey, what if we do this?
Right.
So, it's going to be interesting what comes around in that arena, because FHA will do a certain amount of things, and that's it.
They're very, very conservative.
Yes. Yeah, and the thing that you're talking about doing, you'll see it in about a decade, right?
Yeah.
But on the proprietary side, it's probably Wall Street money, and they go, we'll do this. Next week, you could have it if you wanted it, So
Yeah.
I think that's what we're going to see going forward personally.
And I'm already seeing, I'm originating these, but not every single day in the weeds, as they say, like you guys. I'm seeing more of the proprietary options, and I think it's great. I mean, again, it provides more options for the clients, and it's filling some of the voids maybe that FHA has where they're so rigid. I mean, they'll provide it, but on the higher loan to values, on the higher values of the homes, all of those, it's nice to have those additional options to really explore.
Yeah, think of FHA as McDonald's of reverse mortgages. You come in through the drive-through and ask for lasagna, you're not getting it, right? But proprietary says, I can handle that. So,
Des, you and your sayings, I love them. You're welcome anytime, please. Oh my goodness. Well, we've talked a lot on reverse mortgages. Is there anything that I haven't said? I got another question. Why is there so many deeds of trust?
There's two on that FHA HECM adjustable.
Okay.
And so it's because you have this ongoing, call it obligation, that the client wants a line of credit. They want a monthly payout. So the first deed of trust is in favor of the lender. And then the second one is tied to that first deed of trust, and it's FHA. So basically FHA is saying if that first, that lender goes under or, can't perform, FHA is going to take it over. So it's already built into the program, so they can take over the loan and provide what the obligation that the client signed up for. The money in the future, they have a way of getting it. So
okay. All right. And to clarify, what's a deed of trust? When lenders do a loan, they record something publicly, make a public record. We're going to do a forward mortgage, for example, of $400,000. You publicly record something that says, hey, you owe American Pacific Mortgage $400,000. It's called a deed of trust. Once you pay them off and satisfy them, then we reconvey or pull back our interest, and that goes away. It does not say the interest rate. It does not say the monthly payment. It just says more or less that you owed a maximum of $400,000. Now, in the reverse mortgages, it works different because let's say the home was paid off. There's no balance, but they put a number on the deed of trust, and maybe that's the maximum. I don't know how they work the actual number, but what I was asking and inquiring is why do they do double deeds of trust? And Des answered that as one is for the lender and one is for FHA. sure they could do an assignment on that first deed of trust, but I've always wondered, why is there 2 deeds of trust? And you nailed it. Thank you.
Well, it's a great question.
Yeah.
And to the recorded number, it's 1.5 times the appraised value, what we call max claim. So like a lot of times a realtor go, hey, doing this to the client passes away. The heirs get the house. And it says, the loan recorded amount was, let's say for argument's sake, $1.2 million.
Yeah.
They go, the house is worth $1 million.
Yeah.
You go, well, first of all, they didn't get $1 million.
Right.
They used $400,000.
Yeah.
What was recorded was 1.5 times. So,
And
a higher number.
That's a great, I'm answering I got my checklist over here. Thank you. No, and that is great because with the reverse mortgage, everybody assumes that you owe that much. And, how do we know is we order what's called a payoff demand. So that way, when you're going to satisfy or pay off that loan, the lender gives you to the T what is their per diem interest, how much their reconveyance fee is, how much their fax fee is.
Right.
They'll tell you everything of what it takes to satisfy that. So when you see dual deeds of trust, don't be alarmed. That's probably a reverse mortgage. And the number that you're seeing on there is not necessarily what they owe. It's 1.5 times. Right. There we go.
Yep.
All right. Anything else before we get going on to our lunch and learn today?
I think we covered it.
I think we did, but I hope people reach out to you just with questions because you're a quality person and you're going to take care of them. And for us, that's the big deal.
Yeah.
We want the client taken care of and getting good information so they can make a good decision. And so thank you for inviting us on. It's a huge thing.
No,
Thank
I'm
you so much.
all the way from Sacramento. I'm humbled that you traveled out here to give me your knowledge, your support, your presentation, and really show our clients that, yes, I know a lot, but I don't know everything. And so it's nice to have a division, the reverse mortgage division that is here from American Pacific Mortgage to, address all of these ins and outs. And, one of these days I'm going to find a question that will stump Des. And I'm sure if he doesn't know it, then we're definitely going to get to the bottom of it, or it doesn't exist. So thank you again. And thank you all of our listeners for listening to G Money Real Talk on everything mortgages and real estate. As we always say, we're out. Thank you.